Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will also appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may follow along also with a PDF version of the slides that can be found in the related content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for at least 50 minutes, and second, respond to 3 of the 4 polling questions that will appear throughout the presentation. You can track your viewing progress in this Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours with a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be in that email as well. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. In the related content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the speaker bio section, you can find more about our presenters, including their contact information. If you need technical assistance, please use the help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
Hello, everyone, and welcome to Budgeting for Artistic Priorities. I'm going to take a second here to introduce YPTC before we get started on our content. So your part-time controller, or YPTC for short, is a professional services firm that has specialized in nonprofit financial management for over 30 years, with the goal of helping our clients sleep at night. Our services include accounting, financial reporting, assessments, automation of workflows, data visualization, implementing best practices, just to name a few. We currently serve over 2,000 clients throughout the United States, as well as clients in several other countries. While we have 13 regional offices and we are growing, we are proud to be able to serve clients remotely in every state of the country. So here's a little bit about us. I'll start with me. My name is Justine Townsend, and I lead our arts and culture vertical specialization here at YPTC. I'm a CPA, and I started life as an actress in that old actress to accountant pipeline. And quickly pivoted into accounting, where I am lucky to be able to serve the arts. I also teach financial management for arts leaders at the University of Houston in their Masters of Arts Leadership program. So I'll turn it over to Maria to introduce herself now.
Hi, I'm Maria Leonetti. I'm an associate at YPTC, and I'm one of the leaders on the Performing Arts subvertical. I'm based in San Carlos, California. I've been with YPTC for 7 years. I have a bachelor's degree from UPenn and an MBA from UNC Chapel Hill. I have about 17 years of accounting experience. Before YPTC, I was the director of nonprofit finance for the Philadelphia Flyers for about 10 years. And like Justine, I also am a performer. That's how I started out. I have about 22 years of performing experience, mostly in operettas and musicals. And now I'll turn it over to Molly to introduce herself.
Good morning, everyone. My name is Molly Yun. I'm an associate of YPTC and also the leader of the Performing Arts subvertical. I have over 10 years financial management experience, and I have been with YPTC for over 3 years. Before accounting became my career, I started as a guzheng performer, a traditional Chinese string instrument. So yes, I traded a 21-string zither for spreadsheets, and somehow I still get to support arts. We do offer CPE for today's presentation, and we've included some detailed instruction on how to obtain your CPE. You have to stay with us for at least 15 minutes and answer at least 3 poll questions in order to get your CPE today. You can also download the slides. And let's review today's agenda real quick. We'll start by reviewing the current funding trends and the industry benchmark for performing arts organization. Then we'll take a high-level look of the budget process. After that, we'll discuss how to plan your season while balancing your artistic priorities while achieving financial sustainability. And then finally, we will evaluate both artistic and financial outcomes. Please keep in mind that we designed this presentation with performing arts mindset because we all have that background. However, these concepts can be applied to all arts organizations regardless of their specific focus. So don't worry if you're with a museum or working as an art consult. There is something here for you to take into your next season planning. And with that, I will take it over to Maria for our first poll question.
Thanks, Molly. Yeah, this is our first poll question, first chance for CPE. We're just wondering who's joining us on the call today. Are you a board member, program or development team member, executive director, CEO, or are you a member of the finance team or something else? Give you guys a few minutes to answer that.
And if you are something else, if you're other, please put it in the Q&A box because we would love to find out who else is joining us.
Yes, absolutely. Thanks, Justine.
Oh, we saw someone putting E in the chat. Would you mind telling us what that exactly?
Oh, on the programming side. Yeah,
An education director. Awesome.
Mm-hmm. I love seeing retired.
Yeah, retired is great.
Oh, and I saw some folks from YPTC.
Fantastic. Well, we're at 88% or 89% of attendees, so we'll give you just a couple more seconds. All right, fantastic. I'm going to go ahead and publish this.
Okay, so yeah, a lot of finance team members. Everybody wants their CPE, and yeah, executive directors, CEO, board members, and we talked about some of the people in the other category as well. All right, I'll turn it over to Justine to get things started.
Fantastic. So we are going to start with what's happening right now, what are some of the trends in the industry benchmarks we're noticing, and take a look at how they're maybe impacting your organization and how you should take that into account. Before we do that, though, we want to make sure that we're all on the same page by what we mean by artistic priorities. So artistic priorities refer to the core values, goals, and principles that guide your creative and programmatic decisions. So these priorities help your organization determine the types of works that you create, produce, present, as well as how you engage with artists, audiences, and even your broader community. Some interesting artistic priorities we've seen recently that we are really excited about are mental health in the arts, aging in the arts, arts education at a much younger level, new works and commissions, folks with that focus of really fostering those new works or fostering young or emerging artists. So showcasing those and giving those younger emerging artists a venue. Reimagining classics. for the modern era, or even having a focus on accessibility to finer arts. I've seen some great work with veterans in the arts, and that kind of crosses over into that mental health space. And then really focusing on community engagement. And to just kind of swing it back to aging in the arts, there is a fantastic video out there, I think it's on TikTok and YouTube, of Jane Fonda talking about how art classes can add 7.5 years to our aging patrons' lives. So let's set the tone for what we're going to cover today. And that is a basic equation. And that basic equation is your mission plus your artistic priorities, plus the reality of where we are in time and in our climate, equals your budget. And we are going to use this equation to underlie our entire presentation today. So now I'm going to turn it over to Maria to talk about some of the risks and really focus on that reality piece.
Thanks, Justine. So as we discuss the economic pressures we face, we'll divide them into two categories: price, or the cost of delivering our mission, and audience behavior, particularly as it relates to the demand for your programming. So when we're thinking about price, tariffs, if implemented, could change our overall cost of doing business and drive down demand. And the difference between the cost per performance and the revenue per performance widens. Ticket cost prevents audiences from returning more frequently, especially newer patrons. Yet we're seeing costs for arts companies increasing. Staffing costs are rising. For example, many performing arts companies were affected by collective bargaining agreement concessions during the pandemic. And with those concessions expiring, payments for union artists and stagehands are increasing. And then as we look at the behavior of our audiences, keep in mind that while we may think of the arts as a basic human requirement, the general public tends to think of it as a luxury item. Luxury purchases like opera or orchestra tickets decline when basic needs must be met during periods of high inflation and tariffs. Younger patrons tend to be more likely to buy last minute and are less loyal than the patrons we've seen in the past, and this makes it more difficult to forecast demand. On the other hand, we are seeing some positive trends, particularly with subscriptions. Demand for subscriptions has improved, largely driven by big name headliners or aggressive discounting strategies. If patrons can only get access to a particular high demand show or get a discount to it by subscribing, you can increase demand for the shows in your seasons that are more difficult to sell. I'll turn it over to Justine.
Fantastic. So as we're thinking about the impact of inflation, we first want to think about how to define inflation. So the Federal Reserve defines inflation as the measurement of the increase in the prices of goods and services over time. So higher inflation can lead to lower purchasing power. And our overall cumulative inflation since 2020 is through the end of 2024. So just to be clear on where those numbers lie, as accountants, we like to be very exact in this. So from 2020 to the end of 2024, total inflation, cumulative inflation has been 26%. So if you have not raised your ticket prices by 26% since 2020, then you are maybe receiving more total revenue, but you're able to do less with that revenue. And the same thing goes for your contributed revenue, correct? So as we're thinking about that contributed revenue piece, we're really looking at that changing regulatory environment where there have been significant cuts to grants, cuts and cancellations of grants from the National Endowment for the Arts, from the National Endowment for Humanities, from the Institute of Museum and Library Sciences, and from the National Science Foundation. So with you no longer being able to rely on those federal funds, you may be thinking, oh, we're going to just make up for it with our state or local grants. But it's really important to look at what is the actual source of those state and local grants, because many of those were coming from that higher level federal source that is no longer going to be coming down the pipe. So as you are thinking about what your reality is, you need to take into account how that kind of trickle down is going to impact your organization. Additionally, what we are advising clients to do is to really shift the focus of from those government grants to replace them with corporate and foundation grants. And we do have some resources at the end of the slides, which we're encouraging you to download. One of those resources is an article we've recently published on how to go after those corporate and foundation grants and why you should. Additionally, you need to think about replacing some of your aging donors with younger donors. And we're going to have a great example shortly of an organization who's doing a great job of that. So I'll turn it back to Maria.
Thanks, Justine. In looking at industry trends, we also want to think about what types of risk we can plan for. When we produce commissions or world premieres, we need to keep in mind that we have a lack of historical data, which makes it more difficult to forecast demand. We may have a lack of historical data on that particular work, but if we've done world premieres in the past, we can look to what happened the last time we did a premiere as potentially helpful data. And we also want to consider the changing climate. And what once wasn't controversial may now be controversial. Pivots to the classics have been bringing audiences back in the last few years, but you may be wondering if we can use the classics to talk about current issues. An example of an opera company that did this really well is Tulsa Opera. In conjunction with their production of Carmen, they produced an event with a local social services nonprofit that discussed domestic violence and offered resources for interveners and survivors. And of course, we have to consider our economic climate. We've discussed tariffs and inflation a bit already, but in our forecasting process, we want to make sure we consider how these will affect our endowment and foundations we may rely on for funding. And now I'll turn it over to Molly to talk about some industry benchmarks.
All right. Now that we've looked at the key industry trends, let's dive into the financial landscape. Using organizations with budgets between 1 million and 5 million as an example, our team created this dashboard to help visualize the balance between contributed income and program service revenue. Across the sector, program service revenue, such as your ticket sales, subscriptions, and program fees, has been steadily recovering post-pandemic. However, contributed income remains essential in closing the gap. In this example, the industry benchmark for contributed income stands at 62%, while program service revenue accounts for 33% of total revenue. As Justine mentioned earlier, with the recent budget cuts at NEA and some other arts agencies, we see some organizations are shifting their focus towards individual and corporate giving and leveraging corporate sponsorships for new works. In addition to that, many organizations are exploring co-productions and the revenue sharing model as creative ways to manage costs and maximize the impact. Co-productions can reduce overhead and production expenses while expanding audience reach and artistic scope. Revenue sharing agreements can also provide a more sustainable financial model by distributing both the risk and the rewards of our performance across multiple partners. Our team did a webinar last year on revenue diversification that included 34 different ideas on how to diversify your revenue. We've included the link of that webinar at the end of this presentation. I strongly encourage you to check it out. So one takeaway from this data is that performing arts organizations that diversify their revenue mix, particularly by strengthening relationships with individual donors and corporate sponsors, are in a stronger position to withstand economic uncertainties. Relying too heavily on one single revenue stream, whether it's your ticket sales or through the foundation grants, increases financial risk. As we continue today's presentation, I encourage you to think about where your organization falls on this spectrum. How diversified is your revenue mix? Are there any opportunities to deepen engage with your individual donors or attract new corporate sponsors through new works? These are some of the questions that will help drive financial sustainability in the years ahead. All right, we talk about artistic priorities. We've reviewed the current trends and the industry benchmarks. Now let's take a look at the budget process. First, let's start with a very important question. Why do we budget? Like the former President Joe Biden says 20 years ago, don't tell me what you value, show me your budget, and I will tell you what you value. At its core, a budget is much more than just numbers on the spreadsheets. It's a strategic tool that helps nonprofit organizations assess whether they have the resources needed to fulfill their mission. A well-structured budget forces an organization to set clear objectives and providing a roadmap for where it's heading to. But it's not just a finance team exercise. It should be supported by everyone in the organization because each department plays a role in financial sustainability. And then most importantly, a budget isn't a set it and forget it document. To be effective, it needs to be regularly compared to actual results so adjustments can be made when needed. Now, what exactly is a budget? It's often thought of just a collection of numbers, but it's much more than that. A budget is a financial plan that outlines expected income and expenses. It is a decision-making tool that monitors an organization's financial activities. And like we always do say, where the rubber meets the road, because this is where planning turns into action. At the end of the day, a budget is all of these things.
So now I'm going to get into policies that are impacting the budget process. These policies can be set by the board of directors, by your collective bargaining agreements, or by management. Although they are primarily set by the board, it is important to document all of your policies and distribute them to everyone involved in the budget process. So, what should you be documenting? What policies are those? You want to document activities and programs that should be cut or expanded, and your process for evaluating those. We are going to walk you through at the end of this how to do a quantitative and a qualitative assessment of each program and activity for each department. So don't worry, we're going to teach you how. And then you want to look at, with inflation, is it time to adjust your prices and fees, especially looking at your education programming? We think a lot about where we should put our ticket prices, and especially if we're using dynamic pricing, sometimes really audience demand is absolutely driving those ticket prices. But how about everything else that we're doing? Are we really looking at that? And then looking at your collective bargaining agreements. Are they going to be renegotiated in the middle of the next fiscal year or in the middle of a season? If so, have you allowed for a contingency for that? Or are you setting expectations prior to negotiations for what you anticipate being able to afford? And then it's very important when you budget for your equipment purchases or required maintenance of your venues or your buildings that you look to not cutting this first, because it is very difficult once you get in the habit of cutting this as a cost-saving measure to stop cutting that every year first. And all of a sudden you've got crumbling infrastructure, and donors don't really enjoy paying for a building you've let crumble. They much prefer to pay for a new building, right, than they like to clean up the one that you already have. And then the next thing is you really want to think about making sure that when you budget, you're budgeting to feed your liquidity policy. We learned during the pandemic how important it is to have a reserve on hand, right? We need, is it 3 months? Is it 6 months of cash? Is it 12 months of cash, right? Last time we had that shuttered venue operators grant, we had the Paycheck Protection Program. We don't have a situation right now where we could rely on that in the same type of emergency. So it's very important that we pivot to ensure that we're able to handle that ourselves. And we do that by budgeting a surplus. And then the next thing is to make sure that you are thinking about how you are allocating costs. So any shared costs, so buildings, computers, all of those things are shared costs. We really need to document how are we sharing those costs between departments. And that's going to be very important, especially if you get audited, because you are required to disclose your methodology. So it's important to determine that ahead of time and document it and ensure that you're accounting for those allocations throughout the year. Now let's go through very quickly, what are those best practices in that budget process? First, we want to develop a budget calendar. And when we develop that budget calendar, we want to make sure that we allow for the inefficiency of proper budgeting. Proper budgeting should include everybody who has a say and who can impact your budget, right? So every department head, any department manager, any budget manager, you want to make sure you've had an opportunity to work with them. And in addition to that, you want to give your board, your finance committee, your budget committee, however your organization is structured, you want to make sure that they have the time to really be involved in that process. Don't expect your board to rubber stamp it. You want to evaluate the impact and the return on investment on programs and fundraising activities from the prior year. Again, we're going to cover how to do this at the end of the presentation. You want to make sure that you've established those artistic and organizational goals, right? So this is where it's important to have what is your strategic plan? And here's where you identify what are those artistic priorities we want to achieve ahead of time so that your budget can be reflective of them. You want to make sure you've distributed budget templates to each person who will be involved in the process and also taught them how to utilize them. Then you want to make sure that you develop those expense items and you've clearly documented the assumptions that go into those expense items that you've determined. Then you'll develop your budget, your income budget items. Again, documenting those assumptions all along the way. Where did you come up with these numbers? Who are you raising this money from? How many different foundations will you be applying to? Really identifying where that's coming from so that we're not just budgeting manna from heaven, but actual, realizable income. And then we want to preview that budget draft. That's when we review it to ensure that what we said we were going to do, we did with our budget, that it does align with our values. And then we're going to go through the process of approving that budget. Again, allowing your board an opportunity to take a look at it and to give you feedback. Giving the board a budget on December 31st and saying you have to approve it right now because we need one starting tomorrow is not going to be a great idea, especially since they're partying, hopefully. So then you want to make sure you've distributed that approved budget, especially when we've gone through many iterations of the budget. What you don't want is different department heads managing a budget to a template or to a budget draft they had 3 or 4 budget drafts ago, especially if the board came back and gave you feedback. So ensuring that you've really gone through it and distributed it. And then the next thing is to implement and monitor the budget. And we're going to cover in detail how to do that shortly. So I'm going to turn it over to Maria now.
Okay, thanks, Justine. Once you have your budget draft in place, you're going to review it for your artistic goals. So note that the CFO or controller may need to combine individual templates from different staff members to create one budget master draft, as Justine referred to earlier. The board should review that master draft and discuss the assumptions that, of course, we documented already. There is a temptation often to try to plug a deficit by increasing contributed income by the shortfall to set up a break-even budget. But this is often unrealistic and can set your staff up for failure. We've seen this happen, and unfortunately, it tends not to end well. This is why it's not uncommon for nonprofits to budget for a deficit, particularly if they anticipate spending down restricted net assets from prior periods. As Justine mentioned earlier, it is common for the board to send back the budget draft to staff for adjustments, which is why you have you may have multiple iterations of your budget. So now that we've talked about the specifics of developing a budget, let's think about what are our artistic priorities. So we're going to take another poll question. Which of these options do you think best fits the top artistic priorities for your organization? Remember, you need to answer 3 of the 4 poll questions to get CPE. Do you want to expand new works and commissions, increase community engagement and accessibility, attract and retain new audiences, elevate artistic excellence through your programming, or is it something else? And if it's something else, just put it in the Q&A box. We'd love to hear what you're doing. Give you guys a few minutes to answer here.
I love
all of the above.
All the above.
Yeah, I like all of the above.
Okay, it looks like we have a pretty good response rate at this moment. So we're going to go ahead and publish the results.
Okay, we have a pretty good mix here. Attract and retain new audiences seems to be up there, and then increase community engagement and accessibility. That's great, and I loved reading some of the other responses. I love all of the above.
Yeah, lots of all of the above in the responses in the Q&A.
Yeah, lots of all of the above in the Q&A. So I'll turn it over to Molly to start talking about season planning.
All right, thanks, Maria. It's always interesting to see how artistic priorities vary across organizations, and these priorities directly influence how we plan that season. Now, let's explore how to align season planning with these artistic goals while achieving financial sustainability. When planning a season, it's all about finding the right balance between your artistic priorities and the audience demand. You want to create performances that fulfill your mission while also ensuring that your audience is engaged and returning for more. A good example is recognizing the difference between art that is created and the art that is seen, meaning we need to support innovative work, but also ensure that it reaches and resonates with the audience. This balance isn't just about programming decisions. It's a management tool that helps protect your organization's mission and priorities in the long run. And finally, strong season planning isn't just about present. It also makes your organization more resilient in time of crisis. When unexpected challenges arise, having a clear artistic and financial framework in place allows you to pivot and adapt rather than react in panic. So we just talked about balancing the arts priorities with audience demand, but there are other key factors that influence budgeting and planning decisions. Let's take a look at 3 key drivers: time horizon, funding options, and cost-cutting measures. First, the time horizon. Good financial planning requires balancing short-term needs like your programming and funding for the upcoming season with long-term investment in new works and major projects. Sustainable planning keeps both in focus. Next, the budget funding, the funding options. With cuts to the NEA and aging major donors, some organizations are turning into individual and corporate giving. This shift requires us to rethink how we engage donors and sponsors to ensure long-term financial sustainability. A great example of innovative thinking comes from one of our favorite clients, the River Oaks Chamber Orchestra in Houston, Texas, and their local Rooter program. They offer on-site childcare during performances, which removes a common barrier for parents who want to attend concert. But it doesn't stop there. This initiative also creates a meaningful opportunity to build stronger relationship with those families. It's a brilliant way to engage today's busy parents while while planting seeds for the next generation of donors. Programs like this demonstrate how reimagining donor engagement can not only meet today's needs of supporters, but also serves as a strategic way to begin replacing aging donors by building long-lasting relationships with the younger generations. And finally, the cost-cutting measures. When revenue sources become uncertain, organizations often look at where they can reduce costs. But cost-cutting isn't just about slashing the expenses. It's about understanding your opportunity costs. Organizations must prioritize programs and investment that aligns with their mission while making thoughtful trade-offs for long-term sustainability. And next, I will turn into Justine to dive into income forecasts even more.
Thank you so much, Molly. So we want to use all available data to develop our income forecast, and then we can use that data to inform our evaluation of whether or not we have balanced artistic value and audience demand across the season. Don't worry, there's going to be a really cool graph to follow. So you want to ensure that you allow for error in your assumptions, especially with those new works and commission programs. This is one of those, I know Maria spoke about this earlier, but this is one of my favorite things to do, is to reach out to your friends and other markets that are similar to your own, to ask them, what are you doing? What did you do? How was the result of this? Especially if you're putting on a production for the first time, or you're bringing a new exhibit to your community. That's a great opportunity to see how has it worked elsewhere. Another way to use this is if you do a co-production, sometimes it's worth it to go second so that you can get that data from the presenting company that went first with that co-production. So it's not all, you don't always want to be the world premiere. It's sometimes great to be the second in that world premiere range. And then you want to make sure that you are budgeting and allocating based on those generally accepted accounting principles. So that means that we're doing accrual accounting in our budget, and we're doing accrual accounting all year long. If we budget on a cash basis, then our budget is always going to look way off from our financial reporting. And it is extremely inefficient and costly to convert your cash basis financials or your modified cash basis financials to accrual basis at the end of the year. Additionally, you don't really get that full financial picture. So we really encourage everyone to be on a GAAP basis. In addition to that, you want to make sure you're documenting all of those budget assumptions. So here are some examples of what that looks like. And that is, well, these ticket sales, our total ticket sales includes, we're expecting to do a 5% price increase. And so if you're using dynamic pricing, that means that you have a 5% increase on the floor of your dynamic pricing and a 5% increase on the ceiling of your dynamic pricing. And then you want to think about whether or not you're using a projected increase in sales in addition to. So if you know you have a production, or you have an exhibit, or you have something new this year to your community that has been very popular in other communities, you want to make sure you've noted why that number is so much higher than maybe your other numbers, correct? And then you want to do projecting what exactly your cuts include. So if you have projected a 70% decrease in government funding due to those federal changes, but then the state and local trickle down happens late in your season, and you see it's going to be greater than a 70% difference than the prior year, documenting that it was 70%, and here's why, will really help you understand how to pivot here. And if you're doing, and this is one of my favorite little tidbits about the company that Molly talked about, and that's a River Oaks Chamber Orchestra, or ROCO in Houston. They do a pay what you can model. And so for them, their assumption is we are going to have an increase in the number of attendees and ticket buyers, But because of pay what you can, we anticipate that actually resulting in lower revenue. So that would be a very clear assumption we would want to document if we were doing a program like Pay What You Can, where our focus is accessibility and not the growth of revenue. Here's the fun graph I promised you. So after you've taken that information and you've figured out what your income is projected to be for each program that you plan to put on in the next season, and you've talked to your artistic director or you've talked to your visiting artist about what is the artistic value of this, or you've evaluated for yourselves as management or as the board, how does this impact those artistic goals? So which of these programs are helping us achieve those artistic goals, right? So that's going to be our y-axis, and you need to assign some kind of number system to those. We used 0 to 5, but you could use a 0 to 10 range. And then you want to look at, okay, what's our projected revenue? If you're doing Pay What You Can or you're doing free performances, you might, instead of having projected revenue, be utilized for audience demand on that x-axis. You might want to utilize total number of attendees, total number of eyes, right, on that art that is seen. How many people are we going to have looking at it? And really plot it out. This will help you determine what to potentially cut from your programming. We really don't want to program anything that's in that quadrant 1, right? Our goal is, as much as we can get into quadrant 3, let's get into quadrant 3. Now, you're going to always have some of those in quadrant 4, those programs that are really there because they bring in your audience and because they fund the cooler stuff you're doing in quadrant 2 that maybe you need to build an audience for over time. And we've seen some really great examples of this. And one of my favorite examples of this was Gabriela Lena Frank's Frida y Diego opera that has been kind of in that number 3 quadrant regularly across all of the different markets it's been in. So I'm going to turn it back to Maria to talk to us about costs.
Thanks, Justine, and thanks for that great graph. And now on the other side of things, we do want to look at our cost-cutting options. We should identify our key artistic budget items. So we're not thinking about rent or utilities here. For example, we are thinking about artists' fees. We want to negotiate where possible, but while some items can be controlled, like whether or not we want to expand our string section, others may be decided by a preset CBA, like salaries. We do want to document our key assumptions here, just as Justine spoke about earlier, as we're putting together our plan. For example, are we expecting a rate increase from an upcoming CBA renegotiation? Can we budget for overage for our main stage productions to support the creativity of our artistic directors? Do we want to reduce the number of performances to reduce incremental performance costs? Or maybe we've decided to increase commissions paid to artists by 400%. Most importantly, we want to stay nimble in uncertain times. Expect the unexpected. Identify what budget items correspond to essential mission activities or artistic priorities and are off the table for cuts. This is what we call the sine qua non. And on the other hand, which budget items have the least impact on our artistic priorities and our ability to deliver our mission? Make sure we're focusing on the right items during this planning process. And here we have another poll question. Let's think about the demand for subscriptions you've seen as an organization since 2019 or pre-pandemic. Have you seen an increase in total subscribers? And to clarify, we're talking about the number of subscribers here, not subscription revenue, so we can remove the impacts of inflation. Have you had a decrease in subscribers? Is it about the same number of subscribers? Or you can't answer right now because you need more coffee.
And I will say, if you're not an organization that sells subscriptions, please answer as though for your membership. What is your membership like?
Right. Okay, yeah, we have a few people that don't have subscriptions.
And while we're waiting for those responses to roll in, I just want to answer a couple questions that came in through the Q&A chat. And one of them was, is that intrinsic artistic value subjective? Absolutely. That is your value judgment compared to what are your artistic priorities. So that's where you're balancing your artistic priorities with financial sustainability in a single graph, where you can really see, is what we're saying we're doing going to be achievable? Is it sustainable? And I love this. Our donors are our members and our donations are up. That's fantastic. So that's a good indicator. Okay, I'm going to go ahead and publish the results, Maria.
Okay, great. Okay, yeah, a lot of people needed more coffee. I saw people saying in the Q&A they always need more coffee. And that we have, let's see, a decrease in total subscribers seems to be the most popular, but these are fairly close actually, especially between decrease and increase. That's great.
It's interesting, isn't it? Like that's completely between increase and decrease.
And
I think maybe we need to facilitate everybody chatting with each other. Everybody's got an increase. Maybe you'll chat with those who have a decrease and give each other those notes.
Absolutely. So now I'll turn it over to Molly to talk about evaluating results.
All right, thanks, Maria. Don't we always just need more coffee? So we explored the industry trends, we reviewed the budget process, and discussed the balancing your artistic priorities with your audience demand. Now let's turn our focus to evaluating the results. The most important step in safeguarding our artistic priorities during uncertain time is being ready for a crisis and knowing what to do after the budget has been approved. You can't prevent the world from burning, but you can prevent the fire from spreading to you. And that begins with monitoring the budget and the cash through monitoring the budget through timely comparison to actual performances. So what does the timely really mean? During a crisis, it's highly recommended to evaluate cash flow and the forecast on a weekly or even a daily basis. Additionally, ROI for each program should be assessed the following week. This means factoring all related expenses, including your marketing allocations, so you can gain a true picture of your financial performance. We'll dig in that part in just a little bit. Additionally, any significant deviations from the budget should be reviewed by the board. This can be revenue is significantly lower than projected or costs are exceeding expectations. Leadership must step in to determine the cost and ensure proactive decision making. And as crisis continues, the pivots you make may shift. So continue monitoring which program initiatives or revenue strategies are effective and which ones need to be reconsidered. Finally, as a part of the organization's month-end process, the board should review financial results within 2 to 3 weeks of the month-end at the very latest, so that the information is not stale and that there is still time to react to the significant changes before they become unmanageable. We also did a recent webinar on spotting financial risks in nonprofits that included some detailed information on common financial and operational red flags in nonprofits. We've included a link in this resource slide at the end for you to check it out.
So now let's get into how to do those evaluations. So the first thing we want to look at is efficiency. And when you think about efficiency, this is where I really want you to think about impact. This is your impact evaluation. So how valuable is the impact to your artistic goals, to those artistic priorities versus the investment? And when we're talking about investment here, remember, this is our qualitative evaluation. So we want to look at every investment we're making. So that's time, money, community capital, your volunteer time, and any other resource that you are plugging into this. Then you want to look at profitability. So profitability is almost impossible to evaluate without your shared cost allocations. You really need to look at what is the total cost of putting this on or doing this. A key area where I see this being left on the table regularly is with special events, because special events, we tend to just look at, well, what was the cost of that? And not in the staff time that went into that. And we all know that the last week before the gala, it is all hands on deck. Literally everyone on staff is working overtime to get this put in place. So there are real opportunity costs. Additionally, there's additional revenue that should come from a special event, because special events are donor cultivation events. If you're not using your special event as a donor cultivation event, that's a major problem. That is what they are for. So are you tracking the success of that donor cultivation over time? Are we looking at how many donors did we actually cultivate from that event over the next 1 year, 2 years, 3 years after the event? So there's a long drag on evaluating the results from a donor cultivation event. I would argue the same could be true for free performances that we do in communities as well, because those are audience development events. And again, with your education program and community engagement, those are also audience development programs. So how are we evaluating the actual audience development return we're getting from those? After looking at that, then you can really look at your return on investment. And here are some calculations to help you with that. So the fundraising efficiency ratio is one of my favorites to determine whether or not we should continue to do a task. That is taking your total fundraising cost, dividing it by your total contributed revenue. And you can do that total fundraising, or you can do it discretely by type of fundraising activity. So you could do that with a special event. You could do that with, your foundation grant writing time and effort. How is that return? When you look at it overall in the arts, we tend to be a little bit higher on this. So this tells us how much we spend per dollar raised. And in the arts, we tend to be in the 20 cents to 25 cents per dollar raised, because our parties are a little more expensive, versus in general, nonprofits are usually in the 15 to 20 cents range. Then you want to look at profit margin, your profit margin. So revenue minus expenses over revenue. Anything positive is going to work here. If it's negative, you really want to take a look at that. Is it negative because we're spending down restricted funds that were raised in a previous period? And then we want to look at our asset turnover ratio. And we're really looking for that to be over $1. So that is, how are we taking what we have and turning that into unrestricted revenue? Then we want to take, once we've kind of looked at that quantitative and qualitative, now we want to compare that to, well, what are our artistic priorities? What is that sine qua non that Maria brought up earlier, which is, that is what is essential to our mission. That is what is essential to our heart at the end of the day. So what are those that have that highest artistic value, and know that you're going to protect those? So what's the offset to that? How many of those kind of maybe lower artistic value but higher audience demand do you have to do to offset that so that you can have it there? Then when we're looking at profitability, again, make sure you're allocating overhead and all shared salaries. Looking at opportunity cost. If we're not doing if we're doing this, means we're not doing something else. So making sure we're always doing the right and the best thing, the highest value, the highest qualitative and quantitative value activity we could be doing. And then, of course, you want to decide what that success looks like, deciding those key performance indicators before you approve that budget, and making sure that those are also documented as part of your policies and assumptions along the way. So it's very quick and very easy to say we are being successful or we're not being successful, and we don't get feelings involved, and instead we can stick with the facts. Okay, so next poll. Maria, you want to get us kicked off on this poll?
Sure. Now this is our last poll question. So just calling this out, this is your last chance for CPE. So what is your highest priority going into next season? How are you planning to deal with some of the issues we just discussed? Is your goal to increase revenue, Do you want to focus on cash flow management? Are you going to look to cut costs? Are you concerned about planning for the changing political environment and economic uncertainty? Or are you focused on audience behavior, thinking about issues around demand or accessibility?
And while the answers are coming in, I'll just address quickly. One, we're probably not going to have a ton of time to get to questions at the end. So hang tight. We promise we'll come back. But I will just say there's a lot of questions about what should your profit margin percent be, or what should your overhead percent be. And we do, just like we showed you that benchmark, those industry benchmarks on revenue, we also have all of that data for the other side, for expenses, for overhead. We have all of those industry benchmarks. And anybody who puts a question in the chat, one of us will follow up with you directly after the presentation and ensure that your questions are answered. So we are at 80% responded. We're going to go ahead and publish.
Okay, so yeah, increasing revenue, it's definitely the highest. And we have cash flow management and economic uncertainty as close together. Interesting, not as many people focused on cutting costs. Okay, so now that you've evaluated the results of your budget, you can use it as a tool to understand indications of financial trouble and when there's a need for management to intervene. When there is a failure of management to act or to accept the organization's financial situation, all the financial reports in the world can't overcome it. Here on this grid, we can see some indications of financial trouble. We're not going to go over every one of these, but one is declining support. We may see that contributions, grants, or membership dues are less than we anticipated in the budget, which could lead to financial trouble if significant. If you're starting to hear criticism of the organization by the public, this could also signal that a decline in support is coming. You also want to watch out for signals of declining financial independence. Are you relying on just one or two sources of funding in your budget? What was the contingency plan you identified? Is it time to make a pivot? Molly spoke about this a bit when she discussed industry benchmarks, and we also have a presentation on revenue diversification that we'll link in our resources slide. And then you may also see evidence that the organization is postponing current costs. Justine spoke a bit about this. Also, when you see the company selling off investments in order to meet day-to-day expenses, this can signal financial trouble. We're hopefully using our investments for emergency situations or large planned investments, but not to meet day-to-day costs like payroll. So you can read through the rest of these on your own when we send out the slides. But if you want to do a deeper dive into these red flags, we'll also give you a link to a webinar that will have additional information on this called Spotting Financial Risks in Nonprofits, a Guide to Red Flags and Best Practices. And then I'll turn it over to Justine to wrap things up.
So today we have gone through what is our reality. We've looked at what are those best practices around the budget process as a high-level review. And we've looked at how do we balance that, and given you kind of a visual that you could all use immediately because it's pretty easy to recreate, to balance your season planning. And then we've looked at how do you evaluate those results and how often should you be evaluating those results and how to make those pivots. So I know we don't have time for questions. We're right at time. I see so many questions in the chat about getting our benchmark data, which I'll tell you. The best way to get that benchmark data is if we're doing your financial reports, because we will include those in your KPIs and in your data visualizations. Additionally, we are constantly putting out more content with that information, and we'll be including that in a future blog post. If you ask me for it directly, I will reach out to you and see what exactly you need because we have it by budget size. One of us will reach out to cover all of these. One of us will be reaching out to each person in the chat who left a question, and we will make sure that you get your questions answered. So all of these are free webinars that we've listed out. These are all the ones we talked about. When you download the slides, you can get them. And then here are our blog posts. Please continue to follow our blog for additional information. We are constantly putting out, because our goal is to save all the arts everywhere forever. And with that, thank you so much for joining us. Have a wonderful day. And we hope to see you next time.
Bye, everyone.
Thanks, everyone.